Center of gravity is the 200-day moving average at 40.62. Whether you pay attention or not, you have to understand that enough people do pay attention to it that it ultimately matters. What happens at 40.62? You get several days where you close above it, and you're going to see the rules-based, non-discretionary funds come in to buy the market. So you will get, at that point, to 4,100, 4,150. What's also cooperating in this environment, and let's not lose sight of this, is fixed income. Fixed income, investment grade, high yield, municipal bonds, all trading very well right now. And underneath the surface of the market, I think there's something that's somewhat puzzling. If we are going to this period where we're going to see the potential for a hard landing economically, why are financials performing so well? Quarter to date, JP Morgan up 29%, Bank of America up 28%, Goldman Sachs up 31%,
Okay.
Citi, Wells Fargo up 18%. What is that telling you about balance sheets? Balance sheets for consumers and corporations must be in better shape than we're thinking.
But you're thinking that the action you're seeing in some of the areas of fixed income is more of a benefit perhaps for stocks than fixed income itself. You're saying it's a signal of sorts that, you know, maybe the better performance, less concern in fixed income gives a green light of sorts for stocks.
I think
Am I right?
I think that's fair. I think it gives a degree of comfort of what? That maybe we're not going to see the type of defaults that we've seen in other recessionary cycles. It indicates maybe a degree of comfort that, you know what, we're not too far away from a distant time where corporations had the ability to extend maturities at historically low private sector borrowing costs. This time last year, if you're a CFO, you're extending maturities because you knew what was coming from the Federal Reserve. So that need for capital maybe isn't there as much as it was in prior cycles, and corporations probably in a little bit better position.
Now, let me ask you this. Sure. I feel like one of the reasons, spitballing here, okay? One of the reasons why you haven't been able to get much going is because even though people think that Santa Claus is going to show up, that he's going to drive into a snowbank shortly after Christmas. It's not going to last. So is it really wise to get all bulled up for a matter of weeks if the reality says, well, it's not going to last anyway, so what am I supposed to do? Get in and then get out real quick?
Okay. So, I've advocated for active management. I think you have to be active in this environment.
That active?
I think you're picking off 5 and 10% here and there when you can. I think you're trying to find stocks that are going to allow you to outperform. I agree with you. The calendar turning to 2023 doesn't wash away the inflation problems, the conflict between Russia and Ukraine, the monetary tightening. That doesn't get washed away with 2023.
Not only not washed away, it arguably brings these issues that are there closer, right? As much as we say now, the lag effects are legit and powerful for Fed policy. The further you get into the new year, you get closer to the lag effects taking effect.
I don't disagree with that. So what does that mean? That means persistent and high, persistent elevated volatility, the lack of liquidity from the Federal Reserve. I fall back upon, look, Scott, you can't just buy an index anymore. You can't be a passive investor and say, okay, I'm going to buy the S&P 500 because there's a ton of liquidity, the monetary policy is favorable to the environment, and we're okay, just buy and hold. I don't know if that's the right environment. I think you have to very quickly shed losing trades, and you have to look for actively opportunistic scenarios for individual equity names.